Welcome to Market Call. I'm Morella Fernandez. Greg Newman on the show today. He's Senior Wealth Advisor and Portfolio Manager at Newman Group, ScotiaMcLeod. He's going to take your question today on North American equities and dividend stocks. Here's how to reach us. Call us toll-free, 1-855-326-6266. You can also email us, marketcall@bnnbloomberg.ca. Greg, thanks for coming in. We had Donald Trump tariffs paused yesterday, then unpaused. Then we had Trump on social media today post about China not being very cooperative. So still things up and down. Are you seeing responses in the market, reaction in the market?
Yeah. Listen, this rally has been a rally that everybody's kind of hated because it didn't make a whole lot of sense. You still have all this tariff noise. Yes, you have some de-escalation. A lot of people sold near the bottom, a lot of hedge funds, that sort of thing. And they're scrambling to try to keep up and chase this market higher. You know, the tariffs are really kind of hard for people to deal with. I mean, there's this acronym going around, TACO. Trump always chickens out is basically, you know, what the market is starting to believe. I mean, by and large, what I think market participants got wrong in April was that earnings in the United States and Canada held up better than people thought. Forward guidance actually held up better than people thought. There is some de-escalation of this tariff front, hopefully, maybe 2 steps forward, 1 step back today with China. But you know, you ask yourself, does Trump want to be unpopular? No. Does he want to lose the midterms, which are not too far off, which probably is going to happen if he puts the economy in a recession? So you got there, everybody's aligned here to try to not have that happen. You also have some softer inflation data that came out in the States today, but it is sell in May and go away. And you still do have this opaqueness. So what do you got? You got a longer term, 18 months out, that probably looks pretty good with a big, beautiful bill coming in, deregulation, tax cuts, stimulation, spending, that kind of thing. That's going to be good for the economy. But the short term, it's may go away and it's tough markets.
What about the Canadian GDP numbers came in stronger than expected? Does that give you a little bit more optimism about the latter half of the year?
Yeah, well, it certainly doesn't hurt. I mean, what they're saying is that really captured the front running of trying to get in before, and we're still going to see the negative effects. But you know what? There is all this optimism with this new government and being much more stimulative for Canada and getting national projects off the table and reducing interprovincial trade. So, you know what? It's nice to see better than expected number. What does that mean for the Bank of Canada next week? It probably means the Bank of Canada is going to be on hold. They're probably not going to lower. And, you know, our currency has been going up, which I don't think is really a secular Canada trade Canadian dollar call as much as a weak greenback. But, you know, I think investors can take comfort that I think we've seen the big moves down. I think de-escalation is more what we're going to have. But we're still going to have trading ranges, and it is May, and you know markets are back near their high. I don't think you got to like go full in. You need to have an asset allocation.
Got it. Okay, we're going to take a quick break. Line up some phone calls and emails for Greg Newman of Newman Group, ScotiaMcLeod. He's taking your question on North American equities and dividend stocks. We're back in a moment. Welcome back. Greg Newman is our guest today. Let's go to an email from Raymond with his question. He says, should I sell Loblaw? And we will bring up the Loblaw chart right now. It has been on a steady increase. It's at 232.97. It's a record high, apparently, almost 233. So they've had some obviously good times here despite the economic circumstances. Good time to sell?
So that's a great question. You know, it depends where you own it. If you own it in a taxable account, you got to pay capital gains. I'd say no. If you own it in a registered account, I think it's a very, very good question. We've owned this stock for years, under 50, and it was on its back forever. I don't know if people remember a few years ago, but it really had a hard time. And look at it now. And I think there's a lesson in that for all investors that a lot of stocks take their turns, and they're drama, and then they turn around and they, go into greatness, and people are wondering if you should still own it here at this high price. Listen, still has a 10% growth rate, trades at 22 times earnings, which is kind of expensive, but Walmart trades at 33 times, and Costco, which just reported yesterday, trades at 45 times. So compared to them, it's not expensive. I think the whole space is a little bit pricey. I'd put money into other areas. So yeah, I'd be a seller in a registered account here.
Got it. Okay, let's go to the phone lines. David's on the line from Ottawa with his question today. Hi, David.
Hi, good afternoon. Thank you for taking my call. My question is on Bank of Montreal, or all of the Canadian banks, really. Last week this week we had all of the earnings coming out, and they were great. And so the banks have gone up significantly in May. Do you think the bank stocks are overbought? And do you think there's going to be a correction period for all the Canadian banks and Bank of Montreal? And do you own Bank of Montreal for yourself and for clients? Thanks a lot. Have a great day. Thanks
for the question, David. We've got Bank of Montreal up now. It is at 147, almost 148, just slightly up on the day. The banks did do well. They're putting aside more money for bad loans just in case the back half of the year is what it's expected to be. Generally, what's your play on banks?
So listen, they're very resilient here. They're very recession ready. Credit risks have gotten a lot more manageable through successive cycles. The regulatory regime is very robust. There's a counter-cyclical component in better trading in volatile times, which is kind of shelter them. Look, if you're looking to put capital to work, this is a sector that's trading around 11 times, 10.8 times, 8% earnings per share growth with a nice 4.44% dividend. So the sector really still makes really makes a lot of sense. As to BMO, yeah, we own it, and that would be my favorite one in the group. It still trades near the peer multiple. It's got the best growth rate, we think, with Bank of West accretion of about 15% growth rate, and as I say, trading at an inline multiple with the group. So I think it's got some really good upside. I mean, the name for the best quality is Royal, but it's reflected in the price. So you're always trying to figure out which bank is the best for the buck at this time, at this tape.
And BMO is the one in that category.
I think so, yeah.
Got it. Okay. David, I hope that helps you out. Let's go to Sam calling from Brampton, Ontario with his question. I think it's also a bank question. Hi, Sam.
Hi, Marilla. Hi, Greg. How are you guys doing?
Good. Thank you. What's your question today?
My question is on Royal Bank. Greg, what do you see this stock going 10 years from now? Like, I've held this stock for 10 years since from 2010, and I recently sold it, but I think I made a mistake here. I might want to get back into it. But give me an idea here. If I hold this stock again for another 10 years, do you think it will get double or triple?
Okay, so let's talk about growth for Royal Bank. We'll pull up that chart right now. It's at 174. It had got up to something like 179, I think, more recently. Yeah. Is there a lot of room for Royal Bank to grow?
Listen, here's the thing. Royal, it has the scale. It's got a diversified revenue mix. It's got synergy upside. It's got a long-term track record. It's the most trusted bank. But it does trade at a premium. But it's got really nice Bank of Hong Kong accretion upside here. Look, you've done a tremendous job. If you owned this name 10 years ago or 20 years ago or 30 years ago, your dividends alone on your average cost base is really getting up there, 6, 7, 8, 9, 10%. I think over the next 10 years, particularly if Canada is going to be in a more pro-growth phase, and with all the growth that the United States is trying to engineer, that should be really good for Royal. So, it stumbled a little bit on earnings, I think, yesterday, and it was probably a buying opportunity. I think the market probably overdid it to the downside. So, Is it my favorite bank right now to put on new capital? No, it would be BMO, as I say. But they're both good, and I don't think you're going to go wrong by buying Royal.
The
there.
HSBC, you see some upside from that one to integrate a little bit more into the Royal Bank?
That's accretion, that's efficiencies, that's lowering costs, it's bigger market share, really growing into that footprint.
Got it. Okay, let's get back to the phone line then. Richard's on the line. He's calling from Port Ellis in BC today. Hi, Richard.
Hi, good morning to you both. I'm just calling today on Chemtrade and seeing if you like the dividend at this point and maybe some capital growth. Thanks for taking my call.
Okay, thank you for the question. Chemtrade.
So everybody loves the dividend here. That's why people tend to have bought this name. People liked the dividend a long time ago. They made a really bad acquisition, maybe 10 years ago that really punished the company. Off the bottom, though, it's been pretty impressive. And Q1, they just beat by 15%. They just raised their guide. They're doing really good progress on capital allocation, which is really good for investors. Dividend raises, small tuck-ins, more buybacks. The question is do you buy it here? It's trading around 4.7 EV to EBITDA versus about 6.3, which is its normal mid-cycle valuation. So we think they still got upside, and they are building consistency, and their business model does seem to be a lot more robust. So look, I think that it's been working, and I think that on dips you can probably add more capital to it.
Got it. Okay, we're going to take a quick break, line up some more phone calls for Greg Newman. He's with Newman Group, ScotiaMcLeod, taking your questions today on North American equities and dividend stocks. We're back in a moment. Welcome back, and thanks for joining us on Market Call. Greg Newman's our guest. We have Mark holding on the line from Cochrane, Ontario, with his question today for Greg. Hi, Mark.
Hey, how are you?
I'm good. How are you?
Good, good. Great. My question is on Altagas. You recommended it before. Do you still own it? And are you on the bandwagon with this one to sell Maine, go away? Your thoughts. Thank you.
Well, you know what? That's a great question. I mean, I think that you're always got to be putting new money to work. So listen, if you're at your asset allocation in terms of equities, I don't think you need to add. But if you're trying to build portfolios, you're looking for good names that really make sense, that are pretty defensive with some good upside. And I think Altagas really fits that bill. So, Q1, their midstream which is 43% of EBITDA, actually benefits from this tariff noise as producers look to diversify export markets. They're increasing new contracts. The utility business has been doing really well on resilience and data centers and data center growth. So you got both the plays of offshore and data center, offshore gas and data center, which is just a great combination here. Where's it trading? It's trading cheaper than its peers at around 16 times and growing at around 10%. Throw on a 3.1% dividend that's really growing nicely, and I think the stock really works here.
Okay. Let's get back to the phone lines then. We have Michael on the line. He's calling today from Montreal. Hi, Michael.
Hi, Marilla. Hi, Greg. Greg, is it possible to have your opinion on Tourmaline gas for a short to medium-term hold? And since they beat, the numbers for Q1 were ahead of expectations, do you see it ripping higher in the coming months? Thank you very much.
Okay, so Tourmaline's down at 62.26. Obviously, you took that dive mid-April with everything else.
Yeah.
Is there some comeback room here?
Yeah, listen, we think so. I mean, as the caller just said, they had a nice production beat. They had a nice free cash flow beat. Deep, high-quality company, diversified marketing portfolio. And you got to ask yourself, are we in a sweet spot for natural gas as TMX starts to come online and Kitimat starts to export LNG? And we think the answer is. And the company sets up pretty well here. Is it cheap? It's trading in line to its peers. But it does have nice production growth. It's got nice free cash flow growth. Its balance sheet is in good shape. You get paid this nice dividend, and they're great for shareholder returns as well. So, with a 90% payout ratio, so it's pretty safe. So, yeah, I think that you want to buy this one when it's down, and I think it's safe to put some money in it right now.
Got it. Okay, let's go back to the phone lines. We have on the line Joe from Sarnia, Ontario. He has a question today, also a commodity question. Hi, Joe.
Hi, good morning, Marilla. Greg, I'd like your comments on Whitecap Resources, just vis-a-vis buy, sell, hold for this year, and just in terms of the effects of, the Viren merger. I also read in a few days regarding delisting on the U.S. Stock exchange and discontinuing future guidance. Any comments, Greg?
Well, look, so I got some good news and I got some bad news. I mean, we love this new combination.
Viren and Whitecap?
Yeah, and, very synergistic. Strong free cash flow, strong cash flow per share, increased scale, and, they're going to do some asset sales as well, which they're going to use to pay down debt, so it improves their balance sheet. They're doing 3% lower capex, which we think is prudent in this tougher environment for oil. Stock really works. That's the good news. The bad news is it's going to move as oil moves, and oil's in a tough place here. I mean, you've got OPEC this weekend, I believe, and you got to ask yourself: does Donald Trump want to see oil prices higher or lower? And I really think it's as simple as that. And do the Saudis want to play along with Donald Trump? And I think the answer is yes. So this stock still really works at this tape with oil being this. But if oil comes down a lot more, then these are going to be tough places to be.
Got it. Okay. Let's move on to Rick, who's calling from Toronto, Ontario. Hi, Rick.
Hello. Marilla, thank you for taking my call. I have to say, you are a rock star.
Oh, well, thank you very much.
Awesome. I love listening. And Greg, thank you for taking my call as well.
You're a rock star, too.
My question is on Ovintiv. They were previously known as Encana several years ago. They moved to the U.S., and I haven't really heard or seen anything substantial. So my question, is it a hold, a sell? What's your opinion? Thank you.
Tell me a little bit about them.
So they were in Canada, and they're a natural gas play that's basically in the United States. And, it's kind of gotten off the radar of Canadian investors. And the viewer asks a really good question. Is it a good deal here? Q1, their free cash flow beat by 16, lower operating expenses, modestly higher liquids, which is great. They did their buyback, which began in April, which is nice, 8% shareholder returns. We're always looking for companies that are cheap relative to its peers. Is this? Yeah, it's 3.8 times versus 5.5 times its peers, with decent production, kind of flat cash flow per share, balance sheet that's a little bit more indebted than its peers. All in, 51% gas. If you're looking for a balanced play, which is gas and oil now, 59% gas, then I think that this one is cheap relative to its peers.
Got it. Okay, let's take a quick break. When we come back, we will go through Greg's past picks. We're back in a moment. Time now to take a look at past picks for Greg Newman. The picks are from June 14th, 2024, so just under a year ago. At the time, he picked Bombardier on the TSX. Bombardier at the time was 84.25. It's now up to 95.53, a 13% upside return and a 13% upside total return. They make luxury jets, backordered. Apparently, that business is doing very well, despite the times. Do you still like Bombardier moving forward?
We do. This continues to be an accretive growth story with deleveraging. And at the time, though, we were picking it for, potential interest rate reductions and a better economy. We had no idea that there'd be these tariff noise and all these things that have really thrown us about. But in the meantime, the company's been showing really solid execution. Even still with these tariffs, it did a formal guide for 2025, which was nice, which to us appears achievable. Really impressed with their ability to improve margins here in a challenging macro. You flush it all out, this name is not expensive. 11 times 2026, growing at 17%. So on a price to growth basis, it still really works, but not for the faint of heart with tariffs. So, but so far, been escaping that with USMCA.
Got it. Okay. So that was Bombardier, your first pick. Let's move on to your next pick from last June, which was TFI International, which has really dropped off quite a bit this year, now down to 118.52 at the time was 188.90. So a 37% drop, return, a 36% total return drop. What's been going on for TFI International?
So you know what? We were looking for a turn in the trucking cycle, and the stock was already off from its highs. We thought that turn was closer, and it hasn't. It hasn't turned around. So there's been that. And then came tariffs, which really, the stock was like into Trump, or I don't know, 200 or 190. Tariffs really came and knocked it down, and then you really had the company with some kitchen sink quarters where they kind of gave all the bad news. But this is a very cyclical name, and if you buy it at the wrong time, you can have this kind of pullback. But I don't think this is really so much of an if thesis, but a when thesis. Yeah, it's gone against us, but we know what we own here. It's trading at around 10 times 2027, and we think it's growing at around 33%. This has been a great compounder. They always have M&A upside. They do great acquisitions, which are accretive. It's a fragmented business. Then they pay down their debt, and balance sheet improves. Then they do it again. So very skilled management team. This is a long-term winner.
Got it. Okay, let's get to your third pick from June of last year, which was Amazon on the NASDAQ. At the time, it was 183.66, now up to 203.95, 11% upside return and total return. People like Amazon, they sort of worry about the fact that there are imports from China that could be hit or other places that could be hit, but I know they have another part of the business. Moving forward, do you still like Amazon? So,
it's tough to figure out. There's a lot of things here, right? So at the time, it was cheap on a price to growth basis. It was an AI play with AWS, which you just alluded to. At the time, the economy was looking good with advertising. They just did all these capital expenditures, and they were growing into that footprint, which was, very accretive for them. Of course, tariffs have come, and now there's headwinds, and they just put out a softer guide in their last quarter. So we don't see as much robust growth as we did, but we still see 19%, 2026 to 28, not bad. And it's trading at 23 times. So price to growth, really not bad. Kind of like the banks for one of the world's best companies. So I think, do you have to buy it today at 203? Probably not. I think you can probably get it about 190, but this is a winner. Still got more to go.
Got it. Okay, we're going to take a quick break. We're going to line up more phone calls and questions for Greg. Back in a moment. Welcome back. Let's go straight to the phone lines. David's on the line from Celista, BC today. Hi, David.
Hi. Thanks for taking my call. I'm calling regarding Allied Properties. I bought it a few years ago. It's around $18, but it pays like a good dividend, 11.93, and it's just starting to come back again. And I believe it's got enough cash flow to continue paying the dividend. I was wondering what your thoughts are about this stock.
All right. Allied Properties up at 15, or down today, sorry, a little bit at 1581. And it has had quite a decline from the fall of last year, Greg.
Yeah, this has been a real tough space for investors, right? Like, I mean, it's office space, and office has really had a hard time since COVID, and still people staying home. We've been looking for the turnaround for a long time, unfortunately, it's been pretty slow. Ask yourself for new capital now. Pretty cheap. I mean, this name used to be really expensive and now trades at 9 times 2026. Does it have growth? Sadly, it doesn't, so I wouldn't be buying it quite yet. But the balance sheet isn't bad. It's fair, 43%. They're going to be over to make that payout of 11.7%. So global trade uncertainty, is that going to help them? They're saying that it's really not hurting them other than in limited circumstances. So this is not going to be a name if we have a more pronounced downturn in the economy. But if the economy is okay, the stock's probably in the bottoming process.
Okay, so hold if you have it.
Hold if you have it. Would I be adding to it here? A lot of time, no. But a lot of times these things are very counterintuitive, and the rate of change starts to happen before it gets less negative. So there's going to be a magic moment, and you got to always anticipate when that is. But I'm not a buyer yet.
Got it. Okay, let's go back to the phone lines. Chetan is on the line from Toronto today. Hi, Chetan.
Hi, good afternoon, both of you. My question is regarding Gap Clothing, and it delivered a good result. Still, the stock went down. Is it a good entry point? What is your opinion for a long-term hold? Thank you.
Thank you for that question. Let's take a look
Great
at Gap.
question. You know what? I think that the stock is really suffering today on, didn't they say $300 million in costs due to tariffs? But yeah, you're right. It was actually a really good print. And the company does have a strategic vision longer term, and they say that tariffs are going to be neutral to them. And is the stock at a compelling value right now? Retail is a real tough space to play. I mean, yes, if you're looking for a retail stock, this is a good name to be buying right now in today's tape. Is retail a good thing to own? It's a very tough trade. It's like buying airlines. It's you got to be right. It's very economically sensitive. Even Jeff Bezos of Amazon says, you know what? All retailers eventually go broke. Even, somehow they get outsourced or they become, redundant, like Sears, for example. Or you think of all the department stores we knew when we were kids, whether it was Eaton's or, the like, even just the Bay. So retail is really, really tough. But if you're looking for a retailer right now, it sets up good.
All right. Let's go back to the phone lines. And Sal's on the line. He's calling us from Toronto with his question today. Hi, Sal.
Hi, thank you. Yeah, my question is on Salesforce. I had recently just had earnings and seemed quite positive with the and I'm just wondering if now would be a good time to hold, and what's your thoughts of this company in comparison to its peers? Thanks so much.
Okay, thank you for the question. Salesforce did just report.
Yeah.
Go ahead.
No, they beat, they raised, they're doing an acquisition for $8 billion, which we think is really accretive, and they're doing it at a reasonable multiple. Their earnings were flat year over year, but their revenues were up 7.6. They are slashing 10% of their workers, so they're reducing headcount, and they are guiding to 8 to 9% revenue growth. All in, this is a stock that I think you got to own, but you got to buy it at the right price. Right now, it's around 20 times 2027 and growing around 13%. A little better places to be putting capital to work, I'd say, right now. But if you can buy it 5 to 10% lower, I think it's a go. It's
a $262 stock. It's not cheap. Just wondering if that's a value it can hold.
Yeah, listen, the good stocks, it's people do ask about absolute price, and they think 262 is expensive, or they think Berkshire is expensive, but it really isn't about how much it is per share. It's about how much it's going to go up. And you always got to look on a absolute basis, 20 times 2027 versus the market, I don't know, around 21, kind of a market multiple. with a 13% growth rate. Not bad for, one of the greatest companies in this space in the world, like a dominant player. I'm cheap. I want to get it at a better price. So PAG ratio of 20 over 13. I think that you could do a little bit better.
Got it. Okay, let's go and squeeze in another phone call before break. Keith is on the line from Brampton, Ontario. Hi, Keith.
Hi, my question's on Telus. Got a 7.5% dividend, looking for a small capital gain. I want something that's safe. I'm from RSP. I'm 70 years old. I want to hold this for the long term. If I can get 10%, I'm very happy.
Well, I'm with you. I mean, look, this is a tough environment. Maybe sell and may and go away. These guys got just like CRM, just like Salesforce, same sort of multiple, really. 20 times 2026, actually, that was on 27, and 13% growth rate is what we model. So price to growth, not bad. They're trying to make their balance sheet better. They've got protected market share with their public mobile brand, so they're more price competitive. So they've been a lot more resilient than BCE and Rogers. Very well-run company. 13 analysts have upgraded in the last 30 days. 0 have downgraded. This was a top pick for exactly the viewer's thesis that it's a kind of a quiet place to put capital with a nice dividend, more of a, not an if, but a when thesis.
Got it. Okay, so hang on to it if you're happy with not a lot of movement and just a dividend. You're good for that.
But he also wants capital appreciation. And I think that they've absorbed a lot of the bad news, the telecom space. And, the bottom probably isn't far off.
Got it. Okay, we are going to take another quick break. We're back with Greg Newman when we come back in a couple of minutes. Stay tuned for that. Welcome back to Market Call, and thanks for joining us. Let's go to the phone lines. Rob's been holding on the line from Thornhill, Ontario today. Hi, Rob.
Yeah, hi, Marilla and Greg. Two questions. Thoughts on the insurance industry as a whole, A and B, Power Corp in particular.
Okay, thank you for the question.
Great. Well, the insurance space, still cheaper than the banks, still a better growth rate than the banks, still lower payout ratio than the banks. Great place, that is fairly down the line, exempt from tariffs to a large degree. They've got a lot of things out of the way with IFRS. Manulife's got a lot of things out of the way with balance sheet. They've been growing in Asia. They've been growing domestically. And Power is GWO and an Investors Group, which it trades, which are nice and they're growing, cradle to grave financial services, and beautiful dividend, nice discount to its NAV, cheaper than it ought to be, and they've got some upside from private capital and things like Wealthsimple and other investments like that are a nice little surprise. So, this has been a nice. If you're looking for a quiet place to be putting money to work, Power works.
Okay.
Yep.
Let's get in another caller. We have on the line Nazar from Scarborough, Ontario. Hi, Nazar.
Hi, Marilla. Hi, Greg. May I have your thoughts on Sun Life Financial, please? The stock price has moved quite a bit and has reached almost $90. I just heard your comments on the insurance industry in general and in Power Corp in particular. Sun Life has a nice dividend yield. In a low interest rate environment, is it okay to hold an insurance stock? Thanks for taking my call.
Okay, thank you for the question.
For sure, on owning an insurance company, is this the one to buy? They've had some challenges with their U.S. side over the last couple quarters. On the most recent one, though, they beat, and the U.S. trends are starting to be more encouraging, which is good. And I think that's one of the reasons why stocks had such a big move recently. It looks to be back on track. And, you ask yourself, the dividend's really nice, 9.5% growth rate, 10.5 times 2026. valuation of the banks with a growth rate like the banks, I think that you can do better with a Manulife or Power, but it's a nice company.
Okay, so stick with it.
Oh, if you got it, stick with it. I was just talking about which one to be putting new money into. I'd rather be putting new money into Manulife than Sun Life here.
Got it. Okay, let's go back to the phone lines. Dominic's on the line from Montreal. Hi, Dominic.
Yes, hello. Thanks for taking my call. Greg, I'm looking for something boring, like a previous caller. I heard your remarks on Telus. I kind of like Telus more than Rogers, but my call is about Rogers. And the thing I see with Telus is that it's really priced expensively right now at this moment, whereas Rogers has a PE ratio of under 8, lower payout ratio on the dividend, and a respectable dividend. Why such a big difference in the PE ratios between Telus and Rogers? And do you see a good value here on Rogers, or is it a trap?
Is it debt level?
Yeah, balance sheets have been a struggle for all these guys. They were, flat-footed when rates went way up after spending so much, and sub-growth in wireless, less population growth, which they weren't expecting. That was supposed to be a positive, was all the population growth. 4 carriers has been, a lot more intensive. Listen, I think that the viewer's really onto something here. This stock is dirt cheap, 7 times 2026. Unlike Telus, we don't see any growth, though. So people want growth, and there's no growth from 2024 to 26. We do think that there is 7% growth from 2026 to 28 when better things happen, and there is MLSE upside.
What do you think of that investment?
It's going to be great for them, and listen, they're going to do some asset sales, and I think MLSE being taken public is part of the solution. So, which stock were we just talking about before that had a hard time, and there was a lesson in it for investors? This is all stocks stumble at times, and you do want to buy them, and it's probably just the darkness before the dawn right now for Rogers.
You think there's some comeback room?
I do, yeah.
Okay. Okay, Dominic, I hope that helps you out. Let's go to a question from Rob, who has written in. He asks for your thoughts today on Fairfax.
Fairfax. So this was a topic of mine on the show just a couple of years ago, and it was like under, around $700 or something like that.
Now up to $2,000 almost.
Well, it's had a great move. Yeah, they've done a great job growing their book value, great job with organic growth and underwriting, really brisk insurance operations, and their underlying investment success has really improved their earnings per share profile. You ask yourself, should you be buying more of this name? Talk about, it looks really expensive, but trading at 7.7 times 2026, growing at 18%, there's more upside for this name.
Yeah, up 50% in the last year alone. So you would dip in even at this.
Even at these levels, but remember, this was a name that struggled for, 20 years. This was a darling in the 90s and really, really struggled forever. And but they made a great comeback.
Okay, let's get to one more email before we have to take a break. It's from Tori. She writes in, is Exxon Mobil a good buy at this price? We'll pull up the Exxon Mobil chart and have a look at where it's at. But what is your take on Exxon? Yeah, it's down to 101.35.
My first question would be, do you have U.S. dollars? Are you converting? Let's look at it relative to the super major peers. Shareholder returns, a little lighter than peers. Valuation, a little higher than peers. Cash flow per share growth, in line with peers. Balance sheet, better than peers. Payout ratio is in line with peers. So how many boxes does it tick? It's fair. It's fair. Would I be buying an oil name right here in front of OPEC? Maybe, if you believe that the cuts aren't going to be as much as what the market's expecting, but I wouldn't be a better. So I wouldn't be buying a big super major oil company right now.
Got it. Okay, we are going to take a quick break. When we come back, Greg will share his new top picks. We're back in a moment. Welcome back. Time now for top picks. Greg is here to share those. His first one is Brookfield Corporation. Tell me why you like Brookfield on the New York Stock Exchange.
Because I'm scared here, and I'm looking for blue chip names. These guys have been buying back solidly, most in 6 years on Q1. Trades at an 8% discount to our forward NAV. They're seeing growth accelerating, seeing fundraising demand is still really good and on track. Stock is not expensive at 12.4 times price to AFFO. We were just talking about Ally. That's 2 or 3 points higher, but with a growth forecasted of about 17.6 AFFO. Price to growth really, really compelling. Is this a value stock? Yes. Is it a growth stock? Yes, it's both. So again, not an if thesis, but when. And very powerful tailwinds here for this company that even if the economy goes bad, you're going to be okay.
Okay, so you said you were scared off the top. This is just something you feel comfortable investing in given the uncertainty and the downward turn that's possible at the end of the year.
Absolutely. I mean, here's the thing. Money's always coming over. New money's always got to be put to work. And you ask yourself, what should I own and how much of it? And where should I be on my asset allocation? Should I be over my asset allocation? Should I be under my out, or should I be at? And that all depends on the economic outlook, which is hazy, and prices are expensive here. So we're trying to find places that are going to work regardless of the cycle.
Got it. Okay. Your next pick we did mention during the show, which is Manulife Financial. And I wanted to ask you, I know you like the stock, whether or not the exposure to the Asian market is affected by any of the tariff and sort of the disruption between the relationship of the U.S. and China.
That's a great question. And to my knowledge, no. No, I think that, they deal with the second order effects from tariffs, which would be, if the economy is starting to slow down and whether people have less money to do insurance premiums or they have less wealth under administration from market pullbacks, that kind of thing. But, they just had a nice beat. They got momentum still in Asia and in wealth management. Their earnings were up 8%, even after a $43 million charge on the California wildfires. Still cheaper than the Canadian bank stocks at 9.7 times 2026, cheaper than Great-West Life, cheaper than Sun Life, reasonable 10% growth rate, lowest payout ratio of the Canadian peers, pays a really nice dividend growth. Again, not a question of if, but when.
Got it. Okay, let's go to your next pick, which is Citigroup. New York Stock Exchange. Why are you going to Citigroup out of curiosity?
Yes, well, valuation. Listen, you look at the Canadian banks, and BMO's my favorite. It's got a 15% growth rate, we think, and 11% valuation. Let's call it 10.5. That's nice. This one's better. This one's trading at 8 times and growing at around 24%, 2025. So what do they got that we don't have? Well, they got tailwinds from the Trump administration, which are doing a lot of deregulations, which favoring banks. So you want a U.S. bank. Which one is also benefiting from years and years of cleanup and cost cuts? The Citi. So this one works really well. Their earnings were just up 21% in the last quarter. Their fixed income was up 8%. Their equities was up 23%. All in on a price to growth basis, you really can't go wrong. Yes, the tape can toss you around if we go into a bear market. And yes, this will sell off as all banks. But at this level, with this level of growth, it's a really good bet from a risk-reward perspective.
Okay, so just as a counter, and whether or not you're thinking about the one big beautiful bill, which is going to tax investments, Canadian investment in the U.S.
Oh, that's a completely different. Yeah, listen.
I'm just wondering if that's even on your radar.
Of course, yes. Yes, that is a good question that we are concerned about. What are we going to do about it?
Wait and see. You
still got to own U.S. stocks, and I really think. Look, maybe I'm naive here, but I think we have Team Carney in place. And I think that, if we got to get rid of the digital service tax, you've got to be considered a bad country to get taxed like that. I don't think, maybe I'm naive, but I don't think it's going to happen. I think we're going to be able to avoid it, managing, and maybe it'll mean maybe going against the OECD and that Canada. But I think we got to do what we got to do, and so I don't think it's going to happen.
It's a very big threat, right? It's 5 percentage points every year until it hits something like 50.
Yeah.
So if it does come in, it'll be down the line a pretty hard hit. It'll
be hard hit, but there's other. First of all, you can own this through the interlisted, like on the CITI. You can own it, Canadian dollar hedged.
Okay.
You can own it that way if you're concerned about that as well. You still got to buy U.S. companies. And if they're cheaper and more compelling, then, you got to buy them.
Got it. Okay. Greg Newman, thanks for coming in. Have a good weekend.
You too.
And thanks for joining us today here on Market Call. We'll have a quick look at the markets as we head to break. We'll see you again on Monday.